Thanks for joining us for the latest episode of Financial Longevity, the Merlin Wealth Management educational podcast. In each episode, Michael Merlin, founder of Merlin Wealth Management, along with various experts, breaks down complex financial topics to help you increase your wealth span and gain the confidence to enjoy your bigger future. For more information about Merlin Wealth Management, please visit our website at rocco.com/Merlin. You can also find Michael's book, Financial Longevity, on Amazon, Audible, or wherever books are sold. And with that, here's founder of Merlin Wealth Management, Michael Merlin.
Thanks, Tom, and welcome to another episode of Financial Longevity, the Merlin Wealth Management educational podcast. Many of you know that I love great quotes. It's something I have in common with our guest on today's episode. And many of you know that my favorite quote is one from Vince Lombardi, who famously said that perfection is not attainable, but if we chase perfection, we can catch excellence. And I recently found another Lombardi quote that also resonated with me, which is, quote, "The difference between a successful person and others is not a lack of strength, not a lack of knowledge, but rather a lack of will." And I think both of those quotes are really, really apropos today to accepting nothing less than excellence and to be unwavering in those pursuits is really something that has defined the storied career of our special guest today, Greg Fleming, who is the CEO of Rockefeller Capital Management and is a great friend and has been a great mentor to me over all of these years. He is an inspirational leader. He's the definition of what an inspirational leader is. And so I'm really excited to have Greg on the podcast today. Greg and I will talk a little bit about markets, a little bit about trade, because it's impossible to talk about markets these days without talking about trade. And hopefully we're going to talk a lot about AI and how innovations like that have impacted businesses in the past and how it will impact our economy, the financial services industry, and really the lives of everybody listening to this podcast. So with that, I am very happy to welcome my friend, Greg Fleming. Hey, Greg.
Michael, great to be here. Not my first time, so it's nice to be back. And to return the compliment, Michael and I have a long history going back to our former employer. We were both at Morgan Stanley together. I was running wealth and asset management. Michael was one of the top advisors then within Morgan Stanley Wealth Management. And he is the prototype of the world-class advisor that we have brought to Rockefeller Capital Management, who works closely with high net worth and ultra high net worth clients, providing comprehensive advice to meet all of their needs, backed by the different capabilities we've built here at Rockefeller Capital Management. So terrific to be here with Michael, who's doing so much great work for so many families and clients, really across the country.
Well, thank you, Greg. And a big part of what makes Rockefeller great is that we can do things like this. We can share our opinions and our thought leadership together, and also, with our listeners and with our clients. So, with that, one of the things I obviously want to kick off with is, we did a recent market update podcast, David North, the head of MWM Asset Management, and and we talked about several of the headwinds that we have felt have been facing the markets, going into 2025, and whatever those were, whether it was high valuations, inflation remaining at elevated levels, higher interest rates, geopolitical challenges, uncertainty around U.S. policy, from a political standpoint, all that stuff still remains relatively unresolved at this point. Yet, today versus, when we did a market update call in March, we're looking at a market that's making all-time highs again. So, given that backdrop, what are your thoughts about the market's trajectory over the next 12 months?
Michael, if we talk about the path to here, I make a couple of upfront comments here. One, coming into the year, we had a new administration. Now, the second time for this administration, but nonetheless, it was a new administration with the 4 years from the last time they were here. So a new administration is always going to bring new policies. So you had that coming in. We also were coming off of two really positive years in the markets. In fact, 2023 and 2024 were the two best back-to-back years in the equity markets since 1998 and 1999, with returns of over 50% across those 2 years. That meant that there was going to be some adjustment in the American markets certainly relative to markets around the world. We also had the market capitalization of American equity markets at the end of last year was 70% of world market capitalization, which even with the dynamic, exceptional American economy was on the high side historically. So all of these things meant that there was going to be a period of adjustment during 2025 of some kind. What we've seen, and Michael, you just alluded to, is that after peak uncertainty time, which I would say was in April, when the tariffs came into the equation in a very big way. Since that time, uncertainty, while it's still out there, the way you just described, a lot not resolved, it has lessened, and markets have reacted to that. They've gotten used to the notion of the fact that there will be tariffs that are meaningfully higher than anything we've seen in recent American history. And we'll come back to tariffs and the linkage to inflation there, and are we seeing it? When are we going to see it? But they've gotten a little bit more used to that. So I think markets have recovered significantly over the last 3 months because the sense of uncertainty is less than it was, even though it still exists today and there's still plenty of uncertainty around.
Does that feel like a rational reaction to you from markets? I mean, obviously, who are we to decide whether market reactions are rational or not? But it's hard, as I mean, as fundamental investors on our end, in looking for opportunities. One of the things that we have a hard time with is, how do you keep investing in a market that faces some of those headwinds, has had some of the performance and some of the characteristics that you mentioned. I think what we've been looking at in this environment is that it's important to focus on quality. We talk a lot to our clients about we always want to own the highest quality assets we possibly can in any particular asset class, whether that's equities, private investments, fixed income, whatever the case may be. We want to own the highest quality assets. And so we've rolled up our sleeves to make sure that we are paying attention and making sure that our portfolios are representative of those highest quality assets at a time where uncertainty is high, but markets seem to be shrugging it off. Do you agree with that?
Look, I think that's a really smart approach, and I do. The question you asked me about do I think it's rational? The economy has shown great resilience here, and there have been things that have been settled. I mean, you have the fiscal situation, and there are positives and negatives. We could have a debate around the things in there that are pro-growth and helpful, and obviously the level of the ongoing budget deficit remains a problem. But that fiscal situation is resolved. The bills passed, and that's off the table for markets, and that's been a positive and helpful. There's some movement on the trade side. The standoff with China, we walked backwards from that. That still remains to be seen how that's going to land. So, I think markets process it, and you and I have seen this, Michael, over so many years. For me now, I'm well into the fourth decade of this. Markets process a tremendous amount of information, and they do tend to, put it all together. And when there's a sustained move, it does tend to be driven by fundamentals that the market's looking at. And when we get to tariffs, we can talk about it. But the inflation data so far has, been fairly muted. Now, that doesn't mean that the tariffs aren't having some bite, but it does mean that, housing markets and rental markets, there's been good news there on the inflation front. There's good news on the energy front. So, I think markets are looking at the whole scene, particularly, Michael, relative to April, when you and I were talking, not on the podcast, but regularly, when markets were first candidly pretty shocked by the proposed level of tariffs. And from that point to today, the box has been checked on a number of major uncertain items that are off the table. And I do think alongside that and the fact that the American economy is tremendously resilient, I also want to make sure we talk about small business as well, which is such a key part of the American economic picture. When you put all that together, markets are where they are, as always, for reasons.
Yeah, no, I think you make some great points, especially about that the bill being passed definitely does create some more certainty around certain things. I think going to your point about small businesses and business in general, one of the things I think we thought was going to be a positive for the markets this year was, kind of quoting from some conferences we've listened to, that animal spirits would sort of be back in corporate America, whether that's small, large, medium size, that you'd start seeing more acquisitions and more more corporate transactions taking place in the marketplace because of the new administration and maybe a looser regulatory environment than they had been experiencing in the past. Do you think now that we've, as you said, as we've checked some of these boxes, we've gotten the fiscal bill passed, we've maybe got a better idea of where tariffs are going to land, do you think that those animal spirits are going to start coming out? Because that's clearly a positive catalyst for markets going forward.
And I do see some of that. I think there was a pop last November. You saw business sentiment and consumer sentiment post-election. There was a pop, and then the events earlier in the year they muted that. I do think that that with some of the things that have been taken off the table, and you just raised a great point. The administration, the government is very focused on deregulation now because they've got the bill passed. And obviously, embedded in that bill is still a persistently high deficit. Mm. And Michael, just for your listeners to review the math on the deficit, from 1945 until last year, receipts as a percentage of GDP were about 17%. And over that long time frame, spending was about 19%. So there was deficit spending, but it was constrained. And in fact, as late as 2000, when Clinton left office, we had a budget surplus. In the last 5 years, receipts as a percentage of GDP are 17%. So we're collecting a similar amount of taxes relative to the size of the economy, and spending has been 25, 26, 27%. A huge spike in spending. Neither party's gotten that genie back in the bottle. So right. You have these persistent deficits of 6-7% of GDP, even in a pretty full employment economy, which is not something we'd ever seen before in history. You had deficit spending when the economy was weak, but we have 4.1% unemployment and deficits at that level.
Yeah.
The administration's focus to get that deficit down is on growth. And they've got in their numbers 3% real growth. And the way to get 3% real growth, the second way we're going to get to, you and I are going to talk about AI, but they're very focused on deregulation. So they've landed the bill, the fiscal situation, that uncertainty is over. They're working on the trade, very focused on deregulation now. They want to loosen those animal spirits so they can try to get real growth in this country that has not been seen in a long time. And from my vantage point, there's a possibility they actually get there because of this incredible force we have in the middle of our lives today, called artificial intelligence.
Absolutely. But before we pivot to that, I did want to ask you one other thing, which we haven't mentioned yet. But clearly the president feels strongly as well that a way to continue to manage the deficit is also by having lower interest rates. And he has been beyond vocal about the fact that the Fed is behind the curve and should be lowering rates, and has even floated the idea of firing the Fed chair, which we think is a horrendous idea. Not to be closely followed by the idea of having a shadow Fed chair, which I think would also create a bunch of uncertainty for markets. So I guess from your standpoint, do you believe that the Fed is right to be in sort of a wait and see mode, or do you think that they really are behind the curve based on how resilient the economy seems to continue to be?
Michael, it's a great question. And I'm pretty clear on this. And I've been saying this in other forums. I have been critical of this Fed at different points in time, never more than when they were talking about transitory inflation at the end of the COVID time. And then they dropped the word transitory like halfway through that debate and started raising rates aggressively to try to catch up. They were late then. And a lot of people thought they were late at the time, as opposed to 2020 hindsight is available to everybody. But that was not just 2020 hindsight. Here, I think they've been prudent because the reality is we haven't seen this trade environment before in this country, literally in the modern era ever. I mean, these tariffs are at a level, I think before the first Trump administration, the average tariff was 2%. And then it went up a little bit from there. And, right now we're clocking the mid-teens.
Yep.
So this is new. And, and a lot of people are asking, and, I know you and I are going to come to this. Okay, so where is it in the inflation data? but I'd let it play out before I assumed it's not going to have an impact on inflation, because I think that the thing that Fed is most focused on, and I believe this would be obviously a problem for the economy, so the administration cares about this as well, I would assume, is stagflation. They don't want to have a weakening economy at the same time that inflation starts to accelerate,
Sure.
because then they're in a very difficult spot. If they've started dropping rates because of the economy, and they see a spike in inflation, what are they going to do? And it's that word is not been around, Michael, for so long. I have to go back really early in any career to be worried about stagflation. But I think it's a legitimate concern, and the economy has been resilient. I mean, it is hanging in, and I get it that there are some measures that are showing concern. Consumer sentiment, spending, it's more sluggish. Hiring is a little more sluggish. The labor market seems softer, but not in a material way. And therefore, them kind of playing out and making sure that you don't have the inflation worry start to accelerate before they start to move. I think it's prudent, even though, as I said, I have been critical of things that they've done in the past. My sense is what's going to happen here is the pressure will stay there. And by the way, the Trump administration is not the first administration to lean on a Federal Reserve chair. We can go back to Nixon on that. So, that happens. I think he's going to finish his term. I think there will be a lot of, we'll continue to have rhetoric and it'll go up and down, but he's going to finish his term. Exactly when somebody's appointed, I think it'll probably be close enough to the end of his term that it matters less. Markets clearly want to see the Fed independence retained. The market's quite clear on that, as you said. I mean, you said it directly for the Merlin Group and the advice you're giving, but that's a broader sentiment. So I do think that will be maintained. The new Fed chair will be picked closer to the end. The pressure will remain. It'll go up and down depending upon what's happening in the world. So if there seems to be more weakness, you'll hear more statements around, hey, why isn't he moving? But I think here they have been prudent, given the fact that we've got an experiment going on that we have never seen before in modern economic history.
Absolutely. And I think to the same point you made about the markets, where the markets markets are able to get used to things once there's kind of a level playing field. And I think the shock the markets went under when the Fed raised rates at an unprecedented rate back in 2022 was the shock. But now that rates have been relatively steady for a period of time, the market's kind of absorbed that condition. And I think the Fed knows that, and they think that they know they have time, and that if they're going to lower rates, again, like you said, I think the real focus needs to be on stagflation and not, on whether the economy's cracking or not. Clearly, the economy's been able to withstand a whole lot of headwinds, probably the worst of which was that 2022 situation. And yet we still didn't really have, a significant recession or anything like that. So,
yeah, you're 100% right. And the markets do absorb things, and they have. Even during that time. But we remember, Michael, there was some serious dislocation because they were chasing it. They took rates up so aggressively. There were banks that failed.
Yep.
The banks didn't do the asset liability management they should have, but they were caught flat-footed. And you had, banks like First Republic and others that failed, and pressure on the whole banking system. And that was because they were chasing it and trying to catch up. So I think better that they're not, chasing it here and waiting for evidence that, they've got one side under control, particularly given that the economy, there's a lot of resilience. It's, there are pockets of weakness, but this is not by any stretch a major shift in direction yet.
Agreed. And along those same lines, again, to kind of pivot, as you were talking about before, to trade and tariffs. I read a quote from the Treasury Secretary and Reuters, where he said that he believes that the U.S. could collect upwards of $300 billion in tariff revenue this year. And I know from reading ISI, which is our source for macro data, that the collections of tariffs in the last month were the most ever by a significant multiple. So, I guess my first question is, could what the president's doing with tariffs really be an answer to increasing federal, the federal receipts, like you talked about, that 17%, toward balancing budgets, toward paying down deficits. And is it really, as you said, we haven't really seen a ton of impact on inflation yet, but I mean, everything my economics degree would tell you that it's got to be coming, right? So, are we going to see that, number one? And number two, do you really believe that the government's going to use that money to create more fiscal responsibility?
Well, look, I think that when you look at the administration's long-term plan, they've got, I believe, over the next 10 years, $3 trillion of tariff revenue in there. So Besant's using that $300 billion figure. I think they're hoping to collect it this year, and then they're hoping to collect it every year going forward. Which,
Sure.
by the way, Michael, says something about where they think this is ultimately going to settle. I think 300 billion is the equivalent of like a mid-teens average tariff, something like that.
Exactly. Yeah.
So that's where they're pointing.
Yeah.
I do believe that they look at that as deficit reduction. And because when they talk about where the deficit might be as a percentage of GDP over the long run, the Congressional Budget Office doesn't factor in the tariffs into their projections. And $3 trillion over 10 years, obviously a lot of money, even with the level of the deficits we have here. So I think they're crediting that on the deficit side. And then the other thing that they focus on in order to get the percentages of the deficit percentages of GDP down is the growth side. Those are two things. They want higher real growth, and they're going to use that tariff revenue to have the net number be lower. So everything that they're saying when you start doing the math, as we just did, suggests that they're expecting this to the notion that some of these more extreme positions were taken to ultimately back off. If we were at 2%, less than 10 years ago on average tariff, and they're baking in to their 10-year numbers $300 billion a year, more like 15%. That's a big change.
Yeah.
In trade policy, and that's a long time frame when they're building that in. So I think we've got a major shift that they're doing here. But I do think they like collecting the revenue because it effectively is, and they are using that when they look at deficit reduction as part of the deficit reduction.
Sure. And so I think you just led perfectly into my next question for you, which is, clear. They seem to be telegraphing, while it may be more benign than what they originally proposed, still a pretty dramatic shift in the global trade environment. And a lot of people are saying that's because while this idea of keeping American innovation to ourselves is very attractive, the idea that someone's going to fill a vacuum, like if Europe wants to become AI enabled and they've got to buy those chips from China, and all of a sudden China can exert more influence because there's been a vacuum or a pocket left open by the US kind of backing away, that's not obviously an ideal situation either, and that there's a balance between creating what the president is calling fair trade characteristics and this idea of America not being as influential because we're willing to give up trade share. How do you think investors should position themselves as these policies unfold? Because I think finding that happy medium is really going to be important as we kind of watch this unfold.
It is, as the geopolitical puzzle here is complicated because they clearly were trying to, and the Biden administration started this, trying to protect the highest and the fastest and the highest quality chips, keep them out of different hands, and China was on that list, and they're pivoting on that. And I think, Michael, you signaled it. They're pivoting because it turned out to be quite hard to limit the ability of those chips to end up in all sorts of different places, because it is such a global marketplace. So it was effective only up to a point. And then the other thing is, in addition to being able to access the chips maybe through places like the European Union, the reaction of the Chinese was to say, okay, we're going to start building them here. And the last time we had that kind of process led to a lot of the chip production moving to different parts of the world, including Taiwan, out of the United States. The chip industry has had a rough road here. So I think the notion that, look, it's not going to be all that effective, and we want to try to maintain the edge that our companies have, and we don't want to limit their ability to do different things that they think make commercial sense. I think all of that went into that mix. I mean, it's an interesting time. COVID was part of this too. The notion that, look, there are key industries, pharmaceuticals, antibiotics and different drugs that we need to have here that have been produced elsewhere, trying to bring those back to American production. That impetus is still there, but threading it in the real world, which is your point, very tricky. And part of it was the trade negotiation with China. The rare earth metals that they have that we don't have, that we needed.
Yep.
We had to say, well, wait, we need those. So just pulling these supply chains apart and pulling all this apart, it's tricky, and it's complicated, and I think that's part of the reason why the administration's clearly been pushing for trade deals all over the place, and they're under enormous pressure to deliver them. Scott Bessent's out constantly saying we're almost here, we're almost here. It is very complicated. Mm-hmm. All the bilateral ones. So I think the puzzle is a complicated puzzle. For investors, it's very difficult. They have to go back to relying on people like you to say, look, we've parsed this. We're looking at the growth profile of a company, and we either still see it or we don't, whatever the recommendation is. And I think that's that's where professional management really comes in, because it is a very complicated picture.
Absolutely. It is to have literally had the time actually to spend the first part of this year going through every single company that we own and stress testing with different levels of tariffs and listening to what they say on their earnings calls. I mean, you hear it too. Used to be you got the summary of what happened in the last quarter and the forecast of what happens in the future, what was going to happen in the future quarter. Now you get the summary of what happened in the last quarter and the if-then statement. Yeah. Of what could happen in the next quarter, depending on A, B, C, D, E, F, or G, trade policy, tearing apart some of these, global consortiums and partnerships that have gone on for decades. And, I think that level of uncertainty is what we are all facing, as investors right now, which is, again, why I go back to what we talked about before, which is, you have to be very clear about what you own, very clear about what your risks are, like what they are, what your risk exposure is, and that the quality of your assets has got to be unquestioned in an environment.
100%. And Michael, one of the questions you were previewing before that everybody's still trying to figure out, the inflation data has stayed fairly muted. And now there are positives that are keeping it down as well, including energy, and we talked about housing. But where is the $300 billion that we're on track to collect? Who's paying that? And now people are starting to pull that apart. And I think what you're going to find when more data is in, is $300 billion is a lot of money. But if some of that is eaten where the product was made by the producer, and then some is eaten along the way by the company that's going to maybe take parts and put it into something that's sold as a single entity, even if whether that's a car or something. And then you have the retailer. You're going to chop up the $300 billion, and a piece might be outside the U.S., a piece might be in one company, a piece might be in the final retailer, and the consumer might eat a piece, and it's going to be significantly less than $300 billion that the U.S. consumer is actually eating, and that's the piece that leads to the direct inflation. So that's probably part of the reason why there's been a ramp. There was also, once there was this prospect of the tariffs, there was a lot of buying before they went into place, right? So you're stockpiling. Sure. And then they ramp kind of slowly, but they're clearly ramping now. As you said, 30 billion in the last 30 days. So now they're ramped, they've really gotten higher. But now you have different parties along the value chain eating a different piece. And that's got to be part of the reason why you're not seeing, the movement on the inflation side. That and the fact that there are ameliorating factors like energy and like housing and rentals that have pushed inflation down otherwise. So, the whole package has kept it, all those reasons have kept it generally in line, which is another reason why I think, if I'm the Fed, I wait here and I see how it's going to unfold before I move.
Absolutely. I think that's a great, spot to leave it, which is that, the Fed still has, the key thing for the Fed is they still have ammunition. They can still do something. If they were doing it now, that is gone. And if all the things you said that are kind of giving some, cushion to the economy today, whether it's lower energy prices, housing, those things reversed, the Fed doesn't have anywhere to go. So I think they can, to know that they can be that, another cushion for the market if these things that are happening organically somehow fail. I think it's really the smart place to be, and should give us a little bit of comfort that as these uncertainties, and we just covered many of them, work themselves out, there's still, the arrow in the quiver that the Fed still has. So
100%. And
so
Michael, part of the whole pressure and the current environment around the Fed, I think Powell's on his way out. I think he's kind of like, look, I'm going to finish this the way that I think makes the most sense, and he's kind of impervious to the noise, and that's probably a good thing for investors over the time frame here. They're just going to look at the data. They're going to not be rushed. They're going to say, okay, now we think there's enough uncertainty down on the inflation side, enough weakness in the economy. Here we go. My sense is that's probably not till December when you look at the picture now. But it's a volatile world; it could change. But they probably don't do anything until December. But the fact that he's going to play it out, just shooting it straight, he's not trying to be reappointed, not any chance of that happening. I think from a market standpoint, there's some confidence and comfort in that, and that's a good thing.
couldn't agree more. To get unfettered intelligence toward policy because there's no ulterior motive like getting reelected or anything along those lines is I think is definitely a positive for the markets. Turning towards something else that I think we both believe is a huge positive for markets. I'm really excited to spend the rest of our time talking about artificial intelligence. I know you and I'm very fortunate that you and I talk on a regular basis, and it's certainly been the topic of conversation that we've had both between us, with clients, with prospects, with people looking at our firm. It's a big question right now from people. They want to know that their advisors, that their institutions, that their partners are really thinking hard about artificial intelligence and how it's going to impact the way they do business. So can you talk a little bit about how we're thinking about it here at Rockefeller?
100%. And I'm going to talk about it on a macro basis more, but we are, as you know, Michael, very focused on the way it should change the way we do business within Rockefeller. And Michael, you and I share the view that this is an extraordinary development in human society. And I was listening to an investor in AI a week or so ago, does a lot of the early stage investing. And he had a chart that was terrific that showed innovation since the Industrial Revolution, the major pockets of innovation and the impact on the economy and society more large. And you go back to the railroads, and that's like a hill. It's a big hill. The railroads had a huge impact. And then you get to the combustion engine, the turn of the 19th century into the 20th century, oil, the combustion engine, that's a big hill. And then, there's a bunch of things that happen, but they're not as impactful until you get to the internet. And that's probably a slightly bigger hill than those two, but they're all hills. And these are major, milestones in human society. And then he gets to artificial intelligence, and these are hills and they're big hills. He's got a line straight up. And now look, he's an investor in the space, and you could argue that that's part of the thinking. He's getting caught up in it. But the reality is the power of the tools and the speed with which they get more powerful and drive so much of every single company and every single industry and really every single human function does appear to be seminal in human history. And there are people that say that, within the next 4 or 5 years, the smartest bot, the smartest AI tool will be 1,000 times smarter than the smartest person, which, by the way, if that's the case, is roughly equivalent, according to people, from us to the hamster. So, we're talking about, capability beyond anything anybody could imagine. And you and I, we all use it now. Probably many of the people listening to your podcast use the tools. I mean, you go on, and I'm not picking one over the other, but just as an example, Chat GPT, if you have the plus version, and you're on there and you're asking things, I mean, those dots don't hesitate very long before boom. And people who used to spend time, going through the internet, doing a search, trying to find the right article, a lot of it's there, right at your fingertips, and the tools are getting better, at almost a logarithmic rate on an ongoing basis. And it's basically open architecture, here and even around the world. So I think that this could be something that changes everything about our lives dramatically, over a time frame that people still aren't ready for. Years, not decades. Decades could be incredible change. If you look at, when I was at Morgan Stanley, we used to look at, I think the investment bankers put this together first, the time to adoption of major technologies. And you start with the light bulb, and from the time you commercialize the light bulb and you could put it in a house, it was roughly 50 years before half of that houses in the United States had electricity inside the house. And then the radio was like 35 years, the TV was like 25. The iPhone was 4 years, comes out in 2007, and by 2011, half the Americans are walking around with an iPhone. AI just turns all that on its head, and every 6 months there's major progress. So history is going to get compressed here.
Yeah.
Where my dad is 91 and fortunately still here. The things that he's seen over his lifespan are incredible from where he started to now. But in the next 91 years, the incredible change could be in 10 years, every 10 years. So that when you get 91 years, it was the equivalent of everything that ever happened in history, right through my father's lifetime.
Yeah.
So, I think that's what we might be looking at here based upon, what we're talking about. And I know you have similar views.
Absolutely. I think that's such great context too. I think sometimes it's hard to put things in context because they feel so futuristic. I think automated driving, everyone's like, my God, that's Buck Rogers, that's the Jetsons. Like that's
Yeah.
it's not real. But he said, hey, look, 50 years ago, 100 years ago, you never would get in an elevator that didn't have an elevator operator. Right. And today you push the button or you don't push the button.
You don't even push the button. You
right.
Push it inside. Yeah.
You just trust that it's going to take you where you're going to go because it's being run by a computer. And so, eventually we'll feel the same way about a car. Like, why did we care if someone was sitting at the steering wheel? But we don't think about it necessarily in that context. And I think you're exactly right about AI. I've heard people say that today AI is as smart as a seventh grader. Well, I can tell you when I was in seventh grade or when my kids were in seventh grade, they could not have summarized the last 7 TV interviews that you've done in about 7 seconds into, a cogent list of topics and questions the way that AI did in literally about 7 seconds. So, I think that, like you said, it may have been a seventh grader in January. It's already a 12th grader by June. And so that's the rate of speed at which these things are changing. And, I think the takeaway from my standpoint, as far as, yet add another thing to why it's so wonderful to work at this company is that, we are already thinking about these things. We're already out on the front foot. We have, an incredible leader on the technology side in Mark Alexander, who, has already been testing and putting things like this in place. And, we can already see where the benefits are going to come from. I'm just excited for the idea that level of productivity, and what it drives. I think as you and I've talked about before, a lot of people are afraid that AI is going to cost people jobs. And I don't think either of us believe that that's the case. I think someone who doesn't adopt AI will lose their job to someone who does adopt it, but the human element won't go away. Don't you agree?
100%, particularly in this business. The advice that you provide to clients, it's going to continue to be the human element out front and pulling it all together. But if you don't put the tools in place, as you said, then you're just going to be left behind in so many different ways. our colleague, and I know you talked to him as well, Rashir Sharma, our chairman of International, does a lot of writing, writes in the FT every other week, and he's constantly pushing the envelope on things. He has said, and he's right, there's never been a breakthrough technology in human history that cost more jobs than it created. Right. Now, entire industries are going to change here, and they may even disappear. The online education industry is now these tools. So, whatever existed there is on its way to, frankly, to oblivion. So things will change like that. But Michael, you and I talked about this. After the internet really took off, new jobs were created. Who ever heard of a search optimization engineer in the 1990s? Nobody, of course. And then we ended up with lots of search optimization engineers. AI is going to do the same thing, but the risk is to those who don't take it and allow it to create the productivity improvements, the better client experience, all the things that we're focused on. And as you know, Michael, we've got Mark and his technology team kind of on the cutting edge here. But one of the things that best-in-class firms are going to do is to take the AI experts and connect them to people in the business function.
Totally.
Who are very good with technology, but who know exactly what happens day to day in their world, and they're going to work together, because the AI experts and the technologists are not going to know what happens in Merlin Wealth Management that AI can positively change and make more productive, so that you could be working with a materially larger group of clients with effectively the same resources because of AI. So that we're going to pair them. And it's funny, when Mark and I talked about this, and you and I have been talking about this, he was telling me about other companies that are following the same approach, and it's very good companies giving me some comfort. Yeah, this is the way we need to go about this. But these tools are going to revolutionize every industry, every company. But in the final analysis, like the breakthrough technologies of the last couple of centuries, it's likely to enhance employment on an overall basis and create opportunities and growth trajectories and new industries and new ways of doing things that we can't even conceive today.
Absolutely. And I think that's a great place to leave it right now. The idea that I just think, whether we today talked about markets, we talked about policy, we talked about the Fed and interest rates, or we're talking about, revolutionary technology like AI, the key thing is, today, more than pretty much any other time, you have to be accepting of change. And so, again, since you and I are quote guys, I get to get a third quote in here.
I loved your first two, so go for it.
Good. So the last one is a Charles Darwin quote, which says, quote, "It is not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change." And I think that's exactly what we all need to be thinking about right now, whether we're investors in markets, whether we're following geopolitics or politics, whether we're thinking about how revolutionary technologies like AI are going to impact our lives. I think it's change, and change can be very, very good. And so I think, looking at it from that perspective, and thank you as always for sharing yours. It is always super valuable to me, and I know it's super valuable to our listeners. So really appreciate you doing that.
I love to be here, Michael, and I enjoy the interaction and your leadership more broadly than just this podcast series. And you could not, in my eyes, have picked a better quote to close. More than at any time in human history, I believe Charles Darwin was spot on. This is a moment when you've got to be open to change, embrace it in the right ways. And those that do that, it's an incredible journey ahead of us. But it's great to be here. It's always great to talk to the many listeners of your podcast. And I look forward to the next one.
Thanks, Greg. Appreciate it. Until next time, we thank everyone for listening, and we'll see you on our next episode.
Thanks for listening to this episode of Financial Longevity, the Merlin Wealth Management Educational Podcast. To learn more about Merlin Wealth Management, visit our website at rocco.com/Merlin. This material was prepared by Rockefeller Capital Management. The views expressed of the host and guests in this episode are as of a particular point in time and are subject to change without notice. The views expressed by the speakers are solely their own and may differ from or conflict with those of other divisions in Rockefeller Capital Management. This information was provided for illustrative and educational purposes only. From time to time, we may mention specific securities or investment strategies where we have an active position on behalf of ourselves and/or our clients. Any mentions of a specific security or company is purely casual and should not be construed as an investment recommendation, investment advice, an offer of Rockefeller investment advisory or brokerage services, or a projection or illustration of the performance of any particular investment or strategy offered by Rockefeller. Investing involves risk, including the potential loss of principal. Before making any investment decisions, listeners should conduct their own research and consult with a qualified financial advisor to ensure that any investment is appropriate for their individual circumstances. Forward-looking statements, including those presented herein, are inherently uncertain, as future events may differ materially from those reflected, and past performance is not a guarantee of future performance.